Michael Burry's biggest position is also his newest bet, and not many people know about it. And we don't beat around the bush on this channel. Michael Burry's biggest position is actually this one that you see on the screen, 18% of his portfolio, and if we scroll down, it is Discovery Communication. And Discovery Communication is a very interesting stock, and in this video we're gonna look at the reason why the big short man bought this stock. And for starters, one of the strategies of Dr. Burry is to actually perform fundamental research. And Discovery Inc. is actually an American company, and it has lots of television brands like Discovery Channel, Animal Planet, Science Channel, and so on. And so you understand where this is going. Discovery is fighting with the likes of Netflix, Disney, and so on. And in just 1 second, we are gonna compare Discovery to these companies. But remember that this channel is about investing strategies and unpopular plays. So stick around if you want to make money. And as I promised, let's compare Discovery to Netflix, their biggest opponent. So Discovery is a pretty stable company. Let's look at the revenues. And as you can see, there hasn't been a lot of growth from 2017 onwards, but at least it was pretty stable over the last few years. And this is obviously Netflix, and compared to Discovery, Netflix has had an incredible revenue growth over the last few years, and the revenues that I have on the screen start from 2016, but overall the growth has been from 35% all the way down to 24%. So actually revenue growth is not what Michael is seeing in this stock, but there are actually 3 reasons why he picked this stock over Netflix and the others. And the first one is that Discovery is a value play. So if we compare Discovery with all the others, we see that the PE ratio is only 10, and that is compared to, for example, Walt Disney, where the PE ratio is 41, guys. And if we compare it to other companies, Netflix being the first one, 54 is the PE ratio for Netflix. And as I told you in my previous video, stocks with a low PE ratios are favorable and a positive attribute in times of high inflation, basically now. But Mr. Burry does not use a PE ratio like us, normal commoners. He's way more sophisticated, and to screen through large numbers of companies, this is what this paper is about, he uses a special ratio called EV/EBITDA. And EV/EBITDA is actually very simple to calculate. Is the company's market cap plus the company total long-term and short-term debt. And whether you believe it or not, you have to subtract cash and cash equivalents. Funny, isn't it? But the good news is that you can screen stocks using EV/EBITDA as Michael Burry does. And you can do that on TradingView, which is on the screen right now. So you will simply get onto the screener, which is this one, and then look for EBITDA, and then you would select enterprise value stroke EBITDA. And on the right, on this column, you will have the EV/EBITDA, and you will be able to look up stocks and also use it as a way of screening through the whole stock market. So I did it for you, and I actually compared it to the PE ratio, which is 13.17 at the time of recording. The EV/EBITDA is 8, which is actually very good. But what is a very good EV/EBITDA? Do we need to look for a high number or a low number? Well, let me show it to you. And this is again Investopedia, and as general guideline, an EV/EBITDA value below 10 is commonly interpreted as healthy and above average by analysts. So 10 is a good number. However, if we go up, we see that a good number is also from 11 to 14 for the last few years. And that is because a lot of companies are overvalued, at least using this metric. But what if you don't want to use any of these ratios and you just want one number that actually tells you everything? Well, the one thing that I find very helpful is to look at the market cap, which is 14 billion compared to their revenues. So as I told you, the revenues for Discovery is 10 billion. The market cap is 14 billion. You basically pay exactly for the revenues that they are making. That makes it a very fairly priced company at the time of recording. The second reason why Michael Burry's big discovery is again incredibly important, and this is the price of discovery. Look at the incredible drop over the last year in 2021. Mostly it dropped 60%, guys, and conversely, and this is very important, if it was to go back to all-time high, just not even break all-time high, the price would actually more than double. There is a 146% upside. And so what drove this massive price drop? That's the question. Well, discovery drops as discovery plus growth eats into profit. So the discovery reported a 63% decline in net income, so loss of profit basically, year over year, and that is in part to costs related to launching the Discovery Plus streaming service. But here is the kicker, guys. The third reason why Michael bought this stock may fix the revenue issue, and it's by far the biggest reason to buy this stock nowadays. Discovery will merge with Warner Media, but not right away. And yes, there is a massive merger on its way, but first, let me show you why this is incredibly important. The company that is merging, AT&T, is the company merging with Discovery. And if we look down, when we look at the revenues, we see that this company has got $171 billion as revenue, guys. This is a massive company, and Discovery is actually the smaller company of the two. And the company emerging from the merger would have a lot of firepower and would be an absolute behemoth. And we'll have popular channels like, for example, as you can see, Discovery Channel and HBO, but also obviously Warner Brothers, which is obviously a very important asset for this company, the CNN, and obviously big old throwbacks like Cartoon Network from my childhood, and big brands, for example, DC. So even Batman will join the fight. But Marco, the merger has already been priced in. Well, probably not. In fact, the merger between AT&T and Discover is expected to happen, to wrap up in mid-2022, assuming, and this is the challenge because there are challenges ahead, assuming it clears all regulatory hurdles. And in just 1 second, I'm gonna tell you the latest news on these mergers, but first, remember, we'll be looking at more Michael Burry stocks if this video reaches 50 likes, so go ahead and smash the like button. And so, as promised, Discovery chief David Zaslav, we are seeing green light from DC on Warner Media deal. And so overall, it seems that this merger is well on its ways, but there are some very important things that you have to know if you want to play it correctly. Under the terms of the Discovery Warner Media merger, all the 3 classes of Discovery stock, and yes, there are 3 classes, I just wanted to tell you, will be converted into the new Class A stock with 1 vote per share. But here is the kicker. This is incredibly important. AT&T shareholders will also receive a new Class A stock for 71% of the combined company. So make sure that your broker allows for this kind of mergers and for shares to be swapped between one company and another. Thank you for watching, and I'll see you in my next video.